Imagine 90% of people never build real wealth, not because they don't earn enough, but because they fall into the same 7 deadly investment mistakes. These errors trap even smart, hard-working people, keeping them stuck while others move ahead. The secret isn't a Wall Street formula, it's about avoiding the simple mistakes that sabotage your progress. Today I'll show you what those mistakes are, and how to dodge them to build real financial freedom. We'll break down each one, from psychological traps to hidden fees draining your accounts. I'm Money Pilot, and over the next 10 minutes, we'll reveal the 7 traps keeping millions broke. Let's get into it. The first mistake many new investors make? Trying to time the market, guessing when to buy and when to sell, hoping to catch the perfect moment? The idea sounds simple: buy low, sell high, and get rich quick. But in reality, it's much harder than it seems. Even the most experienced Wall Street pros can't do this consistently, no matter how much data or expertise they have. The market is unpredictable, driven by breaking news, politics, global events, and the emotions of millions of investors. Trying to predict the perfect moment is more like gambling than investing. It's a risky bet, not a reliable strategy. Fear and greed take over, so you wait too long to buy during crashes, paralyzed by uncertainty, then end up buying in at the top during booms, swept up by excitement and hype. The result? You buy high, sell low, a classic way to lose money and miss out on real growth. So, what's the smarter approach? Dollar cost averaging. Invest a fixed amount at regular intervals, no matter what the market's doing. Rain or shine, up or down, you stick to the plan. When prices are low, your money buys more shares, taking advantage of the dips. When prices are high, you buy fewer shares, but you're still investing and building your portfolio. Over time, this strategy smooths out the market's ups and downs, helping you avoid the stress of trying to guess the right moment. Dollar cost averaging automates discipline, taking emotion out of the equation and making investing a habit, not a gamble. You're not glued to charts or stressing about timing. You have a system that works for you, even when you're not watching. Consistency and time in the market, not timing the market, is what truly builds wealth and financial security. Set up automatic investments, embrace dollar cost averaging, and put your wealth building on autopilot for the long run. This is the first and maybe most important step to real, sustainable wealth, one that anyone can take, starting today. Don't try to outsmart the market. Let time and consistency do the work for you, and watch your investments grow. The best investors aren't fortune tellers. They're disciplined, patient, and focused on the long term. Start now, stay consistent, and let your money grow for you, one step at a time. Mistake number 2, putting all your eggs in one basket. Betting everything on one stock or sector is risky. If it fails, your whole portfolio suffers. Even great companies can stumble, and entire industries can face setbacks. True diversification means spreading your investments across different companies, industries, and even countries. The simplest way? A 3-fund portfolio: U.S. total stock market, international stock market, and total bond market index funds. U.S. funds give you a slice of thousands of companies. International funds protect you from being too dependent on one economy. Bonds add stability, cushioning your portfolio during market crashes. Adjust your mix based on your age and risk tolerance. This approach is simple, effective, and protects you from catastrophic losses. You're not searching for the next big winner, you're buying the whole market. Diversification is your shield against the unknown. Don't gamble on a single stock. Build a robust, all-weather portfolio. The goal isn't excitement, it's steady long-term growth. Diversify and let your wealth grow safely. That's how you build real financial security. The next mistake is silent but deadly: ignoring fees and expenses. Many investors overlook these small numbers, thinking they're insignificant, but over time, they can quietly erode your wealth. Tiny-sounding percentages like 1% or even 0.5% can cost you tens of thousands of dollars over the years, simply by chipping away at your returns. For example, a 1% fee versus a 0.04% fee can mean a difference of $17,000 or more over 30 years on a $10,000 investment. That's money you could have kept, simply by paying attention to costs. High-fee funds eat away at your returns, even if your account balance looks fine at first glance. The damage is slow, but relentless. Most actively managed funds charge higher fees but rarely outperform low-cost index funds. In fact, studies show that over the long run, Most investors are better off with simple, low-fee options. The solution? Switch to low-cost index funds and ETFs. These funds track the market and keep your costs minimal, letting your money work harder for you. Companies like Vanguard, Fidelity, and Schwab offer funds with expense ratios as low as 0.03%. That means more of your money stays invested and growing. Check your accounts. If you're paying close to 1%, you're burning money every single year. Don't let your hard-earned savings go up in smoke. Make the switch. It's often as simple as selling high-fee funds and buying low-cost alternatives. Most platforms make this process straightforward and user-friendly. Don't let hidden fees sabotage your future. Always read the fine print and ask questions if you're unsure about what you're paying. Keep more of your money working for you, not Wall Street. Every dollar you save on fees is a dollar that can grow and compound over time. Cutting costs is one of the easiest and most effective ways to boost your investment returns. It's a simple step with a big impact. Take control. Review your fees today. Don't wait until years have passed and thousands have slipped away unnoticed. Every dollar saved on fees is a dollar that compounds for you, building your wealth for the future. Don't let fees be the silent killer of your wealth. Take action now and protect your financial future. Mistake 5. Letting emotions drive your investment decisions. Greed takes over in bull markets. You chase hot stocks, take on too much risk, and buy at the top. Then fear strikes during downturns. You panic, sell low, and lock in losses. This cycle of buying high and selling low destroys wealth. The fix? Create an investment policy statement, IPS. Write down your goals, risk tolerance, and what you'll do during market crashes. For example, during a 20% drop, I won't sell. I'll stick to my plan. Your IPS is a contract with your future self, made when you're calm, to guide you when you're emotional. Sticking to a plan turns investing from an emotional roller coaster into a steady process. Boring is beautiful in investing, discipline beats drama. Don't let fear or greed dictate your moves. Write your plan, follow it, and let time do the rest. The best investors are methodical, not emotional. Make your decisions in advance and stick to them. That's how you win the long game. Mistake 6. Ignoring inflation. Keeping money in a savings account or under your mattress feels safe, but inflation erodes your purchasing power every year. If your money isn't growing faster than inflation, you're getting poorer. For example, $15,000 in 1990 bought a new car. Today, it buys a third of one. Savings accounts rarely keep up with inflation. Your real wealth shrinks over time. To beat inflation, invest in assets with a track record of outpacing rising prices. Stocks have historically averaged 10% returns, outpacing inflation by about 7% annually. Real estate and inflation-protected bonds, TIPS, can also help. Cash is for emergencies, not long-term growth. Don't let inflation be the silent thief of your future. Invest for growth, not just safety. The goal isn't more dollars, it's more purchasing power. Make your money work harder than inflation. Mistake 7. Ignoring tax-advantaged accounts like 401(k)s and IRAs. These accounts give your investments superpowers by shielding them from taxes. The 401(k) employer match is free money. Never leave it on the table. Traditional accounts let you deduct contributions and grow money tax-deferred. Roth accounts grow tax-free. In a Roth, every dollar you withdraw in retirement is yours, tax-free. Tax-advantaged accounts eliminate the drag of annual taxes, letting your money compound faster. The ideal order: contribute to your 401(k) for the full match, then max out a Roth IRA, then add more to your 401(k). Only invest in taxable accounts after maxing out these options. These accounts aren't just for the wealthy, they're for everyone. Check your benefits, open an IRA, and start today. Don't let taxes slow your path to financial independence. Use the tax code to your advantage. Prioritize these accounts to accelerate your wealth. Ignoring them is one of the costliest mistakes you can make. Take action now, your future self will thank you. The final mistake: starting too late. It's one of the most common regrets people have when it comes to investing and building wealth. Compound interest is the most powerful force in finance, but it needs time to work its magic. The earlier you start, the more your money can grow on its own, multiplying year after year. Every year you wait to invest costs you exponential growth. Time is the one thing you can never get back, and it's the secret ingredient to building real wealth. For example, let's look at Sarah. She invests $5,000 a year for just 10 years, starting at age 25, and then stops completely. Mike, on the other hand, waits until he's 35 to start. He invests $5,000 a year for 30 years, 3 times as long as Sarah. Yet despite investing less money overall, Sarah ends up with nearly double what Mike has by retirement. That's the power of starting early. The difference? It all comes down to time in the market, not timing the market. If you're starting late, don't get discouraged. The second best time to start is now. It's never too late to take control of your financial future. Even small amounts invested consistently can make a huge difference over decades. The habit matters more than the amount at first. The key is to start, no matter how little you can invest. Consistency and patience are your best friends. You can always increase your contributions later, but you can't get back lost years. Time is your greatest asset. Don't wait for the perfect time or for more money to come in. The perfect time rarely arrives. Start today and let compounding work for you. The sooner you begin, the more you benefit. The act of starting is more important than the amount. Don't be Mike, be Sarah. Give your money the time it needs to grow. Your future self will thank you for the decision you make today. The best time to plant a tree was 20 years ago. The second best time is now. Start growing your wealth today. There you have it, the 7 mistakes keeping people from wealth. Now you know how to avoid them and chart your path to financial freedom. Don't worry if you've made mistakes. What matters is what you do next. Pick one mistake to fix this week. Open a Roth IRA, check your fees, or write your investment plan. Next week, fix another. Small actions compound just like your money. If this helped, hit like, subscribe, and comment which mistake hit you hardest. I'm Money Pilot. Let's fly toward real financial freedom together. See you in the next video.